Hi everybody, picking up on the economics of coronavirus in the labor markets from the last video. Last time we were looking at some of the formal definitions of how we measure labor market health. It's not just the unemployment rate, but we include other measurements like labor force participation rate, employment population ratio. We can look at different classifications of workers. So go check out that video if you haven't already. And what we're picking it up here with is some of the specifics of the labor market impacts due to coronavirus. And so I'm going to start with what we know and then talk about what's possibly to come. We know, first of all, that there have been a number of job losses, either through lack of demand or by government intervention closing down non-essential businesses across the country. This has widely been at the state level in the United States, so have a lot of variation from place to place, which I assume actually will be utilized by researchers well to look at how different policy responses affected the spread and affected all sorts of other economic outcomes. But we have seen that employment in the leisure and hospitality industry have been especially hard hit. Among other industries, it's highly variable by industry sector, but certainly leisure and hospitality, one of the largest hit. We've been seeing employment in this industry grow. It's up to about 11% of total employment now, and we can see on this second graph here that employment in leisure and hospitality has increased nearly 30% since the Great Recession back in 2007 to 9, at a much higher rate than the rest of the private sector, as we see in this gap here. So it's a fairly large and certainly growing industry, particularly relative to other sectors. And the other thing is that this is also highly variable depending on region, where you're living, which state, so on and so forth. Since I am in Durango, Colorado, as all of my students are watching this, I thought I would show some of the disaggregated effects by La Plata County. La Plata County, Colorado, where Durango is. And so got this data from the Census Bureau, County Business Pattern Data, CBP, County Business Patterns, public data online. Like we saw, remember, the national employment in leisure and hospitality is 11%. Here we're up at 20% in Durango. It's the largest employer in the county. The largest employment share, 20%. Retail trade is also highly affected, and you can kind of look down through there and see the different types of industries within La Plata County and how those might be differentially impacted through coronavirus. And unfortunately, it's going to be a lot of the lower wage jobs and the people who are most economically at risk are the ones being impacted the most also by the virus. First of all, that's happening by industry share, by industry and which industries are affected, but it's also due to who is able to work from home, right? So accommodation and food services, not likely to be able to work remotely. So that's where we're moving on this next bit, the nature of work, where we have lots of businesses closing to the general public, takeout only restaurants, service sector jobs, like office work moving to remote, a lot of Zoom meetings and so on. So a lot of these jobs are conducted online, but again, this is many jobs are conducted online, although this is also dependent on the sector of work. This is also dependent on the sector, I guess, of work. Okay, and again, it's favoring being able to work remotely favors workers higher in the wage distribution. So here we're seeing that about 21% of people in the highest 10% of wages, about 21% are able to work from home, and only about 1% in the lowest 25% of workers can work from home. So definitely going to have some kind of distributional effects and possible effects on the income inequality across our country and many others as well. So that'll be something that we can watch as this continues. Okay, moving along. Looking at jobless claims. So now we're going to actually look at the early measurements of what type of job losses we're looking at here. Because it's happening so rapidly and it's so highly variable on even a daily basis, but certainly a weekly basis, we don't have the typical monthly job reports numbers out yet, but there are some weekly statistics that come out, and one of those are jobless claims. So initial jobless claims, let's get our definition here, are the number of new jobless claims, filed by individuals seeking to receive unemployment benefits. Filed by individuals seeking to receive unemployment benefits. Okay. And what we have seen here in the last couple weeks are record high claims. Record high claims at the end of March. Okay, and that's actually let's see how kind of terribly we've shattered the record here by looking at these time series graphs. So this one, this graph here, actually this is March 14th. The initial jobless claims from January 1st to the week ending March 14th, which would have been 2 weeks ago, and shortly after the coronavirus really started picking up here. So before that happened, as we would expect in the recessions, the jobless claims are going up, and this one here is actually our previous record with 665,000 unemployment benefits there toward the trough of the recession, toward the end of the recession. And then during this last decade, we have filed down back to a couple weeks ago, where we do see a tiny tick up. But a couple weeks ago, we were at 228,000, or we could call it 0.28 million. So that's 2 weeks ago, and up until that point, it really has been, a great expansion. And here's our record again. But now, in the last 2 weeks, we've hit two major milestones with this. So this is the exact same graph, but obviously at a much different scale. Much different scale as what's up above. This is our same 665,000 number. This is our same 0.28 million. So now we need to talk in millions because of what's been happening the last couple weeks. 2 weeks ago, the week ending, let's do week ending, this is March 14th. This is March 21st. And the top dot is going to be March 28th. Okay, March 21st, just only less than 2 weeks ago. Here we went up to a record 3.3 million jobless claims that week, and then just this week, only ending just a couple days ago, we have 6.6 million new jobless claims. So between the two, that's nine, almost 10 million jobless claims just within the last 2 weeks. So very, very sharp, very steep and dramatic increase in unemployment claims over the last 2 weeks. Certainly the fastest and also the highest unemployment claims we've had in national history. Okay, so that's what we're looking at with the current loss in jobs. And so let's talk a little bit about what we're doing about it, and then what's to come. So just also in the last week, it got signed into law, but it got introduced a couple weeks ago. The CARES Act, introduced in the Senate, Coronavirus Aid, Relief, and Economic Security. So you've heard all the talk about checks coming to households and a lot of business loans and all that. That is this relief package. Okay, and it's a $2 trillion package. Just to give you an idea of scale on what $2 trillion is, well, first of all, if you wanted to count to 2 trillion, suppose you counted 1 number per second. It would take you over 63,000 years to count to a trillion. Okay, so it's huge. Here we have some ideas of $2 trillion with stacks of $100 bills. We've got the $10,000, $1 million. $1 million you could fit into a backpack. But then you move it up to $1 billion. It's about the size of maybe a small room. And $1 trillion is the size of a football field. And then, double that to get 2 trillion. So just giant sums of money. Back in 2008, during the Great Recession, the aid package under the Obama administration came out to $800 billion. And so we're already up at 2 trillion plus. And it's likely that it may even continue to grow. We'll talk about that in a second. Okay, here's a bit of the composition of aid. We're going to look at that other table in a second. Composition of aid, what's in the package? Mostly business loans of some degree or another. And then here we have these household payments that are commonly talked about in the news, and a bunch of other issues as well. But this is a congressional legislation. This is fiscal policy. I'm going to have an entire video on fiscal policy here in a couple weeks. And so stay tuned for that. We'll talk a lot more about this and maybe even more, depending on what happens between now and then, since it's so rapidly changing. Okay, it is likely the case that this is not the end. Perhaps it's just the beginning, right, of again, fiscal policy. So there are reports in the news about potentially more stimulus packages coming out. Don't know exactly the size of what those are going to be, but again, stimulus packages coming out of Congress for jobs programs. There's talk of an infrastructure program, and so that's likely what's to come. Real quick, I don't want to get into it too much because I am also going to have a whole video on both fiscal and monetary policy, but monetary policy is the other policy tool that we could use in a recession, that we often use in a recession, and that has become, over the last over the last century, more or less, the most prominent way of dealing with recessions. The last century, but certainly in the last 50 years. Unfortunately, monetary policy, well, we've already done some of it, but compared to previous recessions, monetary policy isn't going to work very well. So I'm going to just give you a tiny bit of information about that, but it's going to be much more in a later video. So let's just jump over here to this graph. This is the federal funds rate. So monetary policy, the Federal Reserve buys bonds, and by doing so, it's putting money out into the economy, increasing the money supply. When the money supply goes up, interest rates go down. Interest rates go down, it makes it cheaper for individuals and businesses to borrow and spend money in the economy. So that's the general idea. I'll lay that out in much more detail later on. But the whole idea with monetary policy is to reduce the interest rate, make it cheaper to borrow. Here I have a time series of the interest rate that the Federal Reserve more or less has a toggle on through their open market operations. And I just want to point out, if you look, again, the gray bars, oh, I didn't write that. Gray bars are recessions. Every recession since the 70s, we've gone down by at least or approximately, so here we're up at maybe about 13%, and we went down to 4%, so 9% decrease. Here from 9 down to about, 9 down to about 4, so let's do some math, 5% decrease. And then similarly large decreases every time there's been a recession of about 5% or so. Here about 6 down to approaching 1, so about 5, and here 5 down to essentially 0. So every recession since in the last 50 years, monetary policy tools have decreased the interest rate by at least 5% or more. This time, we're starting out at the beginning of the year with interest rates just around 2%. During the first meeting, they decreased the first quarterly meeting of the year. The Federal Open Market Committee reduced their target interest rate. And then twice before they met for their second quarterly meeting, twice they had emergency rate cuts. And the current rate is down here with their target between 0 and 0.25%, which is the lowest that they can go without targeting negative interest rates, which are a different thing. I might talk a little bit about that. But essentially, we don't have we don't have 5%. We don't even have a quarter of a percent left, and we're only at the very, very beginning of a very severe and sharp recession. So monetary policy is not an option in the traditional sense. The Fed has been doing a couple unconventional policy tools, and so we're going to talk about that: quantitative easing, some lending type programs. So traditional monetary policy, maybe I should write traditional monetary policy is not an option for this recession that we're going to be having, that we're arguably already in. So it's got to be, these fiscal policy programs primarily. Slightly different than a lot of we've had fiscal policy programs in previous recessions in recent history, but monetary policy was our biggest kind of knob that we would turn during recessions. So policy, that's monetary and fiscal policy are both going to be videos coming up in 2 weeks. Next week is going to be financial markets. Okay, but moving on, a couple more things. Almost done, actually. Looking at what else we're seeing in the labor markets, definitely. Oh, what's to come? So, yeah, we had what's the current situation, and now we have what's to come. So we have some forecasts of losing about 17 million jobs in the coming months. Non-farm payrolls are essentially just non-farm jobs. So that's forecasted to drop sharply. That's something that we're going to be able to start seeing to some extent tomorrow. Actually, April 3rd, there's a jobs release. I'll talk about that in just a second. But then definitely May 5th, I believe, will be the April jobs report from the Bureau of Labor Statistics. And the April jobs report will really show the brunt of what's happening so far. We might see some changes in university enrollments. Typically during recessions, there's this counter-cyclical relationship, meaning that when GDP goes down, enrollments go up. Right? Counter-cyclical is a relationship that moves opposite to GDP. Typically, that's what happens. If there are fewer job opportunities available, people go to college more often, or people finishing college go to grad school. But it's going to be really interesting to see if this still holds, because this crisis has affected higher education in ways that are materially different than previous recessions, and so that's yet to be seen. But I guess to some extent we'll see in August and September what enrollments are looking like. Okay, so that's something to watch. Okay, next, will all the jobs return? On here, I want to talk just a little bit about productivity. And we actually have this phenomenon that typically happens in recessions. Productivity actually goes up. And that's largely because effort increases is what the economic literature suggests. And so, for example, during the Great Recession, 2007 to 2009, output fell by 7.6%, but hours worked fell by more. Okay, hours worked fell by more. And so if you have your input falling by more than your output, then that means that we've had a increase in productivity. We have less of both, but we have relatively less input. And so we see this increased productivity over the business site during the recessions. Economic researchers here. This is a journal article from the Journal of Labor Economics, top field journal within labor economics. Effort varies over the business cycle, and they find that people actually work harder during recessions. And so, if businesses are more productive during recessions, that's going to have implications. And essentially, the implication may be delayed. Delays. Let's do delays. Implications in rehiring. So this increased productivity would tend to drag out recessions longer, with companies being able to continue production with fewer workers as we start to approach the end of a recession. So, but when will all the jobs return? Perhaps not initially. It gives companies. It gives companies an opportunity to lay off unproductive workers and potentially not hire them back on, or for whatever other reasons, it gives companies the ability to delay hiring until the economy's really picked back up into full swing. Okay, let's talk about the upcoming jobs reports. One of them is tomorrow. So a couple things that almost are surely likely to happen is that the record 113 months stretch of job creation will come to an end. We've been in one of the longest economic expansions that we've had in decades, and so this expansion is likely, almost inevitably going to end tomorrow with the official reports. But the other thing that's going to happen is that the impacts of coronavirus will likely be understated. Okay, and to understand why that's the case, we need to understand how the Bureau of Labor Statistics actually conducts these surveys to make the jobs reports. So their surveys are done when they ask the workers, when they survey workers. They're asking about the work that the person was doing that for the week that included the 12th day of the month. And so essentially, if you look at a calendar for March, the week of March 8th to the 14th includes the 12th day of the month. And so that's the primary survey week for a lot of the people they're asking these questions. This is not true just for the jobs reports, but all sorts of employment reports through the Bureau of Labor Statistics. Okay, so March 8th through 14th as the reference week. But a lot of the fallout and kind of seriousness of the coronavirus and the changes due to closing businesses and the Jobs Acts and all of these policy changes, they happened right around or mostly after March 12th, after March 14th even. So the monetary policy, it didn't happen until after. And the fiscal policy, the stimulus package, that also didn't happen until after. And so likely and a lot of the, maybe I should have had a second, let's do business closures. Many occurred after March 14th. Okay, where states and governments closed down non-essential businesses to the public. And so a lot of these changes didn't take place until after people were surveyed about their jobs. And so the result of that is many job changes happened or occurred after the survey week. After the survey week. So that's why a lot of these impacts of the coronavirus are likely going to be understated when the report comes out tomorrow. Okay, couple more things. Although tomorrow's report is going to be understated, the April jobs report, which is coming out May 8th, I might have said May 5th earlier, but the April jobs report is likely going to show the largest one-month deterioration in the labor market in recorded history, because it will include all the people in March who lost their jobs, who were surveyed, who lost their jobs after this survey week, and it's going to include all sorts of people who have continued to experience the fallout in the labor markets as we go on. Okay, so April jobs report, that's still a whiles away, but keep an eye out for that one. And then lastly, what about after April? Okay, so here I'm just going to kind of leave it fairly open-ended and say that humans are notoriously bad forecasters, even and maybe especially, but economists, but especially forecasting in a time of such uncertainty, and when things are unfolding unlike many times ever that we've seen before. And just as a result, as a kind of example of how bad of forecasters we are, let me show you this. So, daily newsletter, Real-Time Economics, I highly recommend it if you have access to the Wall Street Journal, which all of my students do, so you guys should download that. It's great. January 22nd email. Soon after the coronavirus started hitting around some places, so it describes the coronavirus up here. We have our first case in Washington. What's the impact on China? Likely transitory, says this economist, with some effects in transportation and retail sales. But this one, I think, in particular, is pretty striking. What's the impact in the U.S.? And let me just start off by saying this guy, Paul Ashworth, is one of the Wall Street Journal's kind of super forecasters. He's ranked as one of the top forecasters by the Wall Street Journal. Works for this company, Capital Economics. Anyway, even if this is the first isolated case of the Wuhan virus in the U.S., develops into a full-scale epidemic, which is unlikely, we wouldn't expect it to have negative impact on economic activity, which couldn't be further from what's come to pass. Certainly, it's not unlikely. It happened, and we wouldn't expect it to have a significant negative impact on economic activity. It already has, and it will continue to do so into perhaps the deepest recession since the Great Depression in the 1930s. Hopefully it won't last as long as that recession, and I don't think that it will, but it's the fastest and deepest that we've gone into a recession in any time in the last 100 years. And then the last bit here, stocks edged up, investors cheered. Okay, and that's a nice segue into the next video, which is going to be the impact on financial markets. Okay, and I'll also tell you that they are no longer edged up from where they were in January. They are significantly down since then. So, yeah, so that's what I have for you on the labor markets. Financial markets are up next. I do have some resources with a lot of really great articles. I have the Fred data here, where you can access and look at all sorts of economic statistics. Jobs reports, one coming out tomorrow. Jobs articles. Here's the academic paper I referenced. Even just reading through the abstract and the introduction can be pretty useful. Some information about the CARES Act, the stimulus package, articles, the actual bill itself. I don't think you'd want to read it, but theoretically, go for it. And then last thing is the newsletter that I was referencing. A really great newsletter. Comes out every morning during the week, and you can check to see if your university, Fort Lewis, we have access to the Wall Street Journal and the New York Times. So you can certainly get this. And otherwise, if you're watching the video, you can check to see if you have access. And if you do, go to this link. It has really great information on economics every day. So I'm going to leave it off there and pick up next time with the effects in the financial markets. Thanks.